Welcome back. You're still tuned into Trading Hour on CNBC TV18, and a key macro cue for us to track today is that India's inflation print for September is likely to stay elevated. It's likely to stay above the RBI's target band for yet another month. This would actually be the 9th straight month. Industrial output for August, meanwhile, is expected to have contracted. So my colleague Ritu is standing by, and she's lined up all of the key expectations for us. Ritu, it's over to you.
Well, thanks for that. Let me start with inflation, where consumer price inflation is seen touching a 5-month high of 7.32% for September, as per our poll, up from 7% the month before. Now, well, that is the median estimate. Forecasts range between 7 and 7.5%. Now, this is going to be the third straight quarter where inflation remains above RBI's target band of 4%, plus minus 2%, which will mean RBI will have to explain its failure to meet the inflation target to the government under the MPC framework. The rise in inflation is expected to be on the back of a rise in food prices and a sticky core inflation. Now, erratic monsoons and supply shocks from the war in Ukraine do lend upside risks to food inflation. Monthly average retail prices of rice, wheat, tomato, etc. continue to rise sequentially, and to the extent the rupee weakens, there could be some pass-through effects to the CPI trajectory. Core inflation is seen at 6.13% as per our poll, which, if it materializes, will also be the highest in 5 months. A quick word on IIP as well, where industrial production growth is expected to remain sluggish for the month of August. It is seen at 1.8%, down from 2.4% in July. The estimates again range from 0.5 to 4.7%. Now, this will be on the back of a slightly higher base last year and a muted core sector growth, where, remember, core infrastructure industries grew by 3.3% in August, which in turn was led by muted electricity output.
Thank you very much for that. To discuss the key CPI and the IIP expectations, we're now joined by Indranil Pan, the chief economist at Yes Bank, on the show now. Indranil, the big narrative about India's macro is that there is relative comfort on our domestic macro versus the global uncertainty that we are going through. But in the last couple of days, we've seen the sharp depreciation in the rupee, which again was going to hurt our imports, which again will then flow through into inflationary expectation. What's the trajectory that you expect from India's CPI today as well as over the next 6 months, and the implications for future rate hikes?
We don't expect the CPI to come below the 6% level before February at least. And beyond that, I think what we are looking at is a relative cool out in the global commodity prices. And by that time, most of the ramifications of global monetary policy dynamics will be already in the price. So at that point in time, we are not expecting the currency to be as be on a depreciating bias as it is today. And there will be a better and a steadier trend in terms of global commodity prices and the sort of depreciation pressure for India. So all that taken together, we are expecting inflation to come down. Do also remember that we'll have a base effect for next year because of the higher inflation prints of the current year. So that also should be beneficial. So next year, broadly on an average basis, we could be looking at inflation at around 5.3, 5.4% levels, not anything below that. We do agree to the RBI's forecast of the Q1 broadly, which is about 5% at this point.
All right. Hi, Mr. Pan. Good morning, and thanks for joining us. So, take us through where you expect most of the pain to come through, and also on the core sector activity. Yes, we know it's expected to remain muted in, the figures today, but how much longer do you expect that this part will stay quite muted?
Well, on the production side, we have a much lower number than what you're expecting in terms of the consensus that you pointed out. We are at a 0.8%. The bigger shock for us is probably the manufacturing sector. And we do see some implication of the higher inflation prints to manifest and the higher monetary policy interest rates to manifest into slower demand growth going forward. The other print that we would be looking at, and this is quite relevant as we go ahead in our growth projections, the gross domestic savings is once again down from the household sector. If I look at it, it's down to 10.8%, which is even lower than the pre-pandemic level. Yes, to a certain extent, there will be normalization, but most of the pent-up demand that we had been talking about is now mostly done away with. And going forward, therefore, the private consumption demand will probably be relatively slow in terms of its movement. The other big enabler for growth that has been there was the government investments, but the pace of the capital outlay within the budget may not have a significant upward bias in the budget, though the finance minister did point out that the budget will be growth oriented. But from a perspective of capital expenditure under the budget, we might not see a significant increase because of the fact that the government is already carrying a high debt GDP ratio. You had asked something on the inflation side also, I guess.
Okay, we'll come back to that point. Just wanted to get your thoughts in on the current account deficit. Rising current account deficit, Indranil, is a big worry. I think in the first quarter it was already at 2.8%. The fear is that it's going to cross 3%. And India's current account deficit has crossed 3% only in two instances, I think in 1991, and the other one was in the taper tantrum of 2013. What's the call now on current account deficit, and what are the implications for the Indian economy and what the RBI can do?
So for me, and this I believe for quite a significant period of time, the current account problem becomes a problem only when your capital account also is weak. And the two instances that you did point out that your current account had increased significantly, the capital flows because of the global dynamics were also weaker. Today, I think we see the same situation. Our expectation on the current account GDP for the current financial year is at a 3.8%. And given the fact that we continue to see weaker trends in terms of the global flows, not only because the liquidity is tightening globally, but also the very fact that the domestic interest rate. So if I compare the India's 10-year interest rate to the US 10-year interest rate, the gap is now very narrow. Doesn't even cover the pace of depreciation that one would be expecting on an annual average basis for the years going ahead. So those are some of the factors which will keep the capital flows muted. There is a significant amount of sort of hope that is coming on the FDI side. But if the growth itself is lower, we will probably raise some questions in terms of the absorptive capacity for the economy in terms of sustaining the 35 to 40 billion in terms of the FDI. So yes, the balance of payments remains in a deficit for us.
Mr. Pan, just one final question. You were mentioning the manufacturing growth. Do you have any targets for that? If you could take us through that. And also with the erratic monsoon that we are seeing, across the country, what is your expectation on just the food inflation as well?
Yeah, so for this month, we are definitely expecting food inflation to go higher. The month-on-month pace that we are looking at is of 0.6%, which is lower than the last month, but significantly still remaining on the higher side. The typical factors in terms of the advanced numbers that we have, tomatoes is a thing which is sort of bounced up quite significantly. Given the fact that we have still sort of rainy conditions in certain parts of the country, one might actually continue to look at damage to paddy crops. So that's one factor that needs to be built in to the inflation prints going ahead. And also the vegetable crops. So this is a very crucial period for the vegetables, especially the tomatoes and the onions. So those are some of the factors that we should be looking forward to. The hope today is that the reservoir levels are good enough and therefore the Rabi should actually perform better, and that could actually provide a buffer to the agriculture segment within the GDP. On the manufacturing side, I did explain that we will be looking at a relatively lower sort of production because the visibility in terms of demand is not very strong. Private capex also doesn't seem to be picking up in a very significant way. And from a GDP perspective, the net trade is definitely negative. That's a drag on the GDP. So for the year, we are currently at a 6.9% in terms of the annual GDP print, which is slightly lower than most of the expectations on the street, even from an RBI perspective, or even from the bilateral agencies whose data we continue to track.
Indranil, pleasure having you with us. Thank you very much for joining in. Let's also invite Mitesh Thakkar to take stock of the market technicals as we move forward. Mitesh, morning, and thanks so much for joining in. There has been a bit of a recovery that we're seeing in the markets right now. So we're up 40 points on the Nifty. Any trade?
Yeah. Rima, good morning. So I think, I'm not very convinced with this bounce back, though I think the good thing is that we are holding just above the 200-day average. But if we yet to see any kind of reversal signals happening on the hourly and the 2-hourly chart, so I think just wait it out. For the time being, trade will stock specific basis. A good short trade will emerge if we start breaking below yesterday's low of 16,950. Then take a 60-point stop loss, play for targets of 16,750 or 16,780 zones. And otherwise, wait for some kind of reversal happening on the hourly charts before going along. So I think for the time being, the bias looks like that we might break yesterday's low and then, explore a short if we start trading below 16,950. For the time being on the stock side, Axis Bank is a buy. That's one buy call from my side. Buy with a stop at about 790 for targets of 820. While on the short side is Asian Paints, which is given some kind of a negative breakdown on the charts. That's a sell. Keep a stop just about 32.80. Look for targets of 31.70 here.
Thank you very much for that. Get into a break. Up next, we'll discuss market fundamental. Dheeraj Sachdev of Roha Asset Managers joins us next.